Welcome to the second FEDAI annual day at this beautiful house. A humble request to all of you to keep your mobiles on silent mode and then we will start our function. Now I request Sri Ashwini Sindhwani ji, Chief Executive FEDAI, to escort Mr. Rajeshwar Rao on the dais. Executive Director RBI. Please occupy the seat, sir. Now I request Sri H.K. Jaina, Chairman, FEDAI, to escort Dr. Amartya Lahiri, Director CAFRAL, on the dais. Please welcome both of them. Now I will request Sri H.K. Jaina to have a welcome speech. Sir, please.
Good evening, ladies and gentlemen. I extend my hearty welcome to all the dignitaries present in this august house on the second FEDAI annual day. I welcome all the senior functionaries of Reserve Bank of India, the CGMs, GMs, and other functionaries, our ex-regulators, senior functionaries of other banks, and treasury heads. We are passing through a very exciting time that throws up a lot of challenges and opportunities. We have seen missiles flying over Japan, top posturing by US and North Korea, a referendum in some parts of Spain, seen demonetization, GST implementation, Doklam standoff. We come across a lot of changes at regular and irregular intervals, and they are very frequent. That's why aptly our theme at the Budapest annual conference was change is the only constant. As all of us know, we have started conducting the FEDAI annual days since last year. The first year, it was graced by Dr. Raghuram Rajan, the then Governor of Reserve Bank of India. He delivered the keynote address, strengthening our debt markets. Mrs. Arundhati Bhattacharya, Chairman SBI, that point of time, she was the chief guest for the function. These type of occasions are need of the time for the financial system in general and banking in particular as an effective tool to get insights on various critical issues from experts in the financial field. We have started inviting experts as guest speakers at our FEDAI Management Committee meetings. One such was held as on 28th September, which was addressed by Dr. Sugata Bhattacharya, Chief Economist at Axis Bank. During the year, Forex market has witnessed a lot of changes on various policy matters, implementation of EDPMS and IDPMS, and issues related to it has certainly posed a lot of challenges to the AD banks, which I feel that we have taken a lot of outreach activities, and all the member banks, they should take it seriously. In addition to this, FEDAI has taken the following initiatives to update its workshop books at regular intervals and digitization of compendium of FEDAI instructions and guidelines. For skill upgradation, we are working in foreign exchange. The employees who are engaged in working in foreign exchange, conducting the examination through IIBF, this examination would be conducted on quarterly basis against the existing half-yearly. Another important one is implementation of FX Global Code of Conduct for all market participants, be it sell side or buy side. The issue would be dealt in detail by Dr. Rajeshwar Rao, ED, Reserve Bank of India, who is the chief guest at this function. FEDAI has formed a steering committee for implementation of Forex Global Code of Conduct by market players in Forex. The revised Code of Conduct has been accepted and will shortly replace the existing Code of Conduct. Monetary policy is key for the success of any economy, be it developed, emerging, or developing. It has direct impact on various issues related to financial and forex markets at macro and micro levels. The keynote address of today is certainly a feast for all of the forex market players, and it is focusing on its relationship with exchange rates. We are indeed fortunate to have with us an eminent personality in the field of economics, Dr. Amartya Lahiri, Director at CAFRAL. I extend my warm welcome to him on behalf of FEDAI and all present here. I conclude it here. I am sure we will have a wonderful time over here. We will have interaction, we will have speeches, and I am sure we will, when we go back, we will be a lot enriched compared to when we came over here. We will have a lot of interaction. We didn't have an opportunity for quite some time. So we were looking forward to that, and I am sure it would be very lively interaction throughout the evening. Thank you all.
Shri Rajeshwar Rao, Dr. Lahiri, Mr. Jana, and dignitaries present there in the auditorium. Good evening and a warm welcome to this second annual FEDAI Annual Day. And thank you, Mr. Jana, for a brief introduction and also covering all the aspects and what is going on and what we are looking at for the looking ahead during the day, during the interactions and the presentations which we have lined up. And now I would like to invite Shri Rajeshwar Rao. I don't think that he needs any introduction. All of us are very familiar with the person. He has been there working in the industry in the Reserve Bank of India as a career banker since more than 30 years. Presently responsible for working as an executive director, looking after Financial Markets Regulations Department, Financial Markets Operations Department, and also the International Department. And before this present assignment, he was Chief General Manager, Financial Markets Operations Department. He holds a degree in Bachelor in Arts and also a Master in Business Administration from University of Cochin. He is also a Certified Associate of Indian Institute of Bankers. Shri Rajeshwar Rao has been associated as a member of the Central Bank Foreign Exchange Working Group, working under the auspices of Markets Committee of the Bank for International Settlements. He has been actively involved in the drafting of FX Global Code and is in close cooperation with the currency market participants. And he has been driving the entire effort in the Indian market to make the people aware about the importance of the code and why it is relevant and what can be done. Under his guidance, FEDAI had constituted a steering committee which had series of meetings and already done a lot of work in this direction. And I think this is the right platform, right forum, where I would like to invite Shri Rajeshwar Rao to share his views and his ideas about how he expects this code of conduct to go forward and how we can work together in this direction for the overall benefit of the industry and the market. Sir, please.
Mr. Jana, Chairman FEDAI, Mr. Sindwani, CEO FEDAI, Dr. Lahiri, my distinguished banker colleagues all assembled here, I thank you for this opportunity given to address the foreign exchange dealer community who are assembled here today. As already told by Mr. Sindwani, I would like to speak a bit more on the new FX Global Code and the way forward. The Global Code was launched in May 25, 2017, after 2 years of discussions and deliberations among the various stakeholders. It's now 4 months since the code has been launched, and when we look back at this juncture, it gives us immense satisfaction that the efforts that started way back in July 2015 have started to yield results. RBI, along with other central banks who are involved in drafting the code, would be gratified that how the global code has been accepted by the market participants within a short span of time, even though adherence to it is voluntary in nature. More and more participants, including central banks, have shown interest in adopting the code as it sets out the global principles of good market practices and provides a common set of principles for guidance to the foreign exchange markets. It is estimated that the forex market daily trading volumes is around US $5.1 trillion. Its strength is integral to the global financial system, and the launch of the global code marks an important milestone in the efforts to rebuild trust in the FX markets following the numerous scandals concerning the wholesale FX markets between 2013 and 2014. While many banks have made substantial progress in improving their systems and controls in response to FX trading misconduct, there are still areas needing further attention, and it is envisaged that the code will strengthen the integrity and the effectiveness of the wholesale foreign exchange market. What is encouraging in this entire exercise is the way the industry has worked together and in conjunction with central banks to right the previous wrongs in the FX market and take lasting strides forward. The introduction of the code represents a real milestone for the FX market and represents the market's best opportunity to date to earn back the trust of both the market participants and the public. Going forward, the FX code would very well be the regulatory catalyst for growth across the global currency markets, since it will bring about greater transparency. Given the kind of effect transparency has had on other industries such as the cellular phone markets, this code may, in the long term, benefit everyone by creating better liquidity. Most of you who are assembled here should already be familiar with the global code. I do see a lot of familiar faces whom I have addressed before on this issue. But to briefly recap, the code is built on 6 primary principles. First is ethics. The idea is fairness and integrity in the FX markets should be promoted through ethical and professional behavior. The second is governance. Clear accountability and oversight of FX markets should be maintained through an effective governance framework. The third is information sharing. Communication with the market participants should be clear and accurate and should protect confidential information of the customers. Fourth is execution. FX transactions should be negotiated and executed with integrity and care. Fifth is the risk management and compliance. The risks arising from FX activity should be identified, managed and reported through effective controls and a compliance environment. Finally, confirmation and settlement process. Post-trade systems, controls and processes should promote the smooth and timely confirmation and settlement of FX transactions. More importantly, the participants who have been involved in drafting the code are keen not just to rest on the laurels of launching a code, but ensure its meaningful implementation. So the focus is on creating awareness, influencing the participants to adhere to the code, and ensuring that going forward, the code remains relevant by having a structured method for updating the code. This process rests on revised structure with the Global Forex Committee at the apex level for monitoring adherence and for revisiting the code, supported by regional country levels, by the regional or national FXEs as the case may be. This process is overseen by the Markets Committee of the BIS. I thought I would discuss a bit more on this evolving structure to ensure implementation of the codes going forward. A formal Global FX Committee has been set up in May 2017, which acts as a forum that brings together the central banks and private sector entities who would aim at promoting a robust, fair, liquid, open and appropriately transparent FX markets. The GFXE, which was earlier an informal group of 8 foreign exchange committees of major jurisdictions, is now being expanded to a group comprising of members from 16 jurisdictions, including India. Major central banks and private sector participants are already a part of the GFXE. Further, it has received membership requests from other central banks who are currently not part of the GFXC to join as members, thereby supporting the principles and good market ethos propagated by the code. RBI is already a member of the GFXC along with FEDAI. However, the structure of FEDAI will need to change to resemble the FXCs in other jurisdictions, and this involves getting other market participants on board, particularly the participants from the buy side, and how this is going to be worked out and how quickly this can be done is something the FEDAI and the banks will have to debate and discuss. GFXC would own, update and maintain the code so as to make it relevant to the evolving market conditions. GFXC would take regular feedbacks from the market participants on various issues relating to the market development, conduct and practices. One such feedback window was on the last look policy enumerated in the code, for which the market participants have given their feedback and which is currently being examined by the GFXC. Another development is an inaugural baseline survey conducted globally across jurisdictions to gauge broader awareness of the code among the market participants. The survey is being conducted by the Bank of England and is currently underway, and it extends till October 16, 2017. So far, I think the participation levels has not been very good. It's only around 30% across the globe. But I would expect that India would give a very overwhelming response on this, and all of the people who are part of the survey are encouraged to take part in the survey and give the feedback on this issue. This survey covers select market participants covering both sell-side and buy-side participants, broker entities and platform providers from various jurisdictions. In India, 38 entities are taking part in the survey, constituting a cross-section of the local foreign exchange market. In India, the propagation of code so far has been spearheaded by the FEDAI and the Foreign Exchange Association of India, first among its members, mostly among the banking community, and to a lesser extent among the broker and the corporate entities. RBI has been supporting the various initiatives of the associations in expanding the reach of the code among all the participants in the FX market. Recently, the FEDAI, as a part of its responsibility towards ensuring adoption of the code by its members, has decided to adopt the new global FXC code in place of its existing code to be in line with the global best market practices. Further, it has also prepared an addendum where it has provided for some region-specific operational aspects and certain simplified examples based on the market practices prevalent in India. A major challenge lies in encouraging the buy side, that is the corporates, to adopt the code. I am sure the corporates, particularly the multinationals, would find value in adopting the code because their counterparts in major jurisdictions are likely to join this initiative. Adoption of the code will enhance their image in the market and place them in a different pedestal altogether. The banks have a very important role in their capacity as authorized dealers to create greater awareness and facilitate the adoption of the code by the corporates. It would be worthwhile to involve the industry bodies in this initiative. RBI, on its part, has been engaging with the various other industry associations such as the FICCI, FEIO, ASSOCHAM and Confederation of Indian Industries to expand the reach of the code among the corporate community, which is going to be a crucial part of our outreach activity. FEDAI, on its part, has also arranged some interactive sessions involving the corporate community to enhance the outreach of the code. RBI and FEDAI would prefer to use every opportunity to ensure widespread dissemination of the code among the market participants. Some suggestions received in this regard were inclusion of the new code in the training curriculum of the Forex training of training institutions, which I feel the banks have already started working towards. I also request the top management of the banks to give due importance to the widespread dissemination of the code among its own staff as well as its Forex market clients. The code also provides mechanisms to demonstrate adherence to the code once adopted. The adherence mechanisms are based on principles of universality, proportionality and transparency. The fundamental elements of the adherence framework comprises of a single high-level statement of commitment that the market participants can sign and publish to demonstrate adherence. A format of the statement of commitment is provided in the code. One reason for a public demonstration is to encourage adherence to the code through peer pressure. As market practitioners and dealers in foreign exchange market, it is each one of us and our responsibility to ensure that we adhere to the principles outlined in the code and try to align our operations and practices based on those principles to uphold the transparency and integrity of the market. The GFXE has put out a website to inform and update the members and the FX market participants regularly on matters relating to the global FXE code. It's also planning to upload the decisions taken by the GFXEs on various market-related issues and also the feedback gathered through regular survey and otherwise. I exhort all the dealers to have a look at the website and provide their valuable feedback, which would help in improving and updating the code. I take this opportunity to congratulate all of those who contributed towards the successful launch of the code and its implementation in India, especially the team in FEDAI who put in so much effort towards achieving the various milestones. But much more needs to be done towards our ultimate aim of a complete adherence by the market participants, for which I request the continued support of the members of FEDAI and other market associations. Thank you and wish you all the best.
Thank you very much, sir, for sharing your views and thoughts on the Code of Conduct. And I can tell you, with your continuous guidance and support, we'll be able to take it forward, and also with the active support of all the member banks. Now, the next step, as you mentioned it rightly, is that we have to take it over to the buy side of the market. And we have already had a round of discussions on this, and with the support of the member banks, we'll be working towards that to make it happen as early as possible and maybe to extend the coverage of the code. Now, moving on to the next part of our session today, a little bit of theory, I should say, that as you can see, the topic we are talking about today is the monetary policy. So in general, if I can talk briefly, the monetary policy refers to the use of monetary instruments under the control of the central bank to regulate interest rate, money supply, and availability of credit with a view to achieving the ultimate objective of economic policy. Sounds very simple. You have got few tools with which you need to manage certain aspects of the market, but unfortunately it doesn't happen. It's not that simple or that straightforward. This also reminds me of my initial days in banking when I joined. Of course, it was all Greek and Latin for me. Somebody coming from a science background and joining the bank over there, I didn't even understand the difference between debit and credit. So my first question to the fellow colleagues over there was, can you guide me how to do what to do? And the simple answer was, Piche dekh aage chal. Just see how it has been done and continue following the same thing. I wish life was that simple. It's not happening like that today. The change, as Mr. Jena also mentioned, is a constant. Then the situation is changing so rapidly, and it's making the things, the policies redundant so fast, then it becomes very difficult to keep track and to follow the history. Now, history is just becoming a reference point for us in the changing environment. And as I read somewhere recently, history, we don't need to necessarily only learn from the history, maybe we need to liberate ourselves from the history and also see how we can benefit from that knowledge and that thing going forward. It's in that context, I would like to share some of the things with you that today, if you talk about one of the oldest issues in international economics, is about the relationship between monetary policy and the nominal exchange rate. We all, being from the forex market, of course, are obsessed with the exchange rate. In the context of modern central banking practices, this question can be rephrased as, how does the nominal exchange rate respond when the central bank tweaks or adjusts the interest rates? Modern monetary policy theory and practice has been heavily influenced by the experiences of developed countries. And a number of these ideas, despite the fact that realities of emerging economies like India are often at odds with the circumstances of developed economies, have made their way into policy making and central banks, mostly due to absence of local intellectual alternatives. And that's exactly what we are trying to develop as an organization, trying to provide a platform and forum to bring out, to discuss these issues in the open and free, frank manner, and to see how we can all gain and benefit from this. And these dissimilarities between the developed market and the developing markets often tend to render the monetary transmission mechanism in emerging economies both unstable and non-standard. And we have all experienced that very often in markets like India. To discuss the effects of policy-induced frictions in the transmission of monetary policy, its implication for the efficacy of policy action in general and exchange rate in particular, today we have with us Dr. Amartya Lahiri, Director of CAFRAL. Dr. Lahiri was previously the Royal Bank Faculty Research Professor and Director of Graduate Studies at Vancouver School of Economics, University of British Columbia. Dr. Lahiri also held the Johal Chair of Indian Research and Institute of Asian Research. He has held research positions at Federal Reserve Bank of New York, University of California, Los Angeles, and also Johns Hopkins University prior to joining the University of British Columbia. Dr. Lahiri's field of specialization are international economics and macroeconomics. He has written extensively on the subjects like exchange rate management, monetary policy, balance of payment crisis, and economic growth. Dr. Lahiri is also a recipient of Faculty Career Development Award and the Departmental Distinguished Teaching Award at the University of California. Dr. Lahiri completed his PhD in economics from University of Maryland. He received his MA in economics from Delhi School of Economics and BA in economics from St. Stephen's College of Economics. And today, as you all know, he is going to share his views and thoughts about interdependence of monetary policy and exchange rate. And so I must acknowledge some of my opening remarks where I was giving gyan about the monetary policy and the market operations and the intricacies. I had picked up from some of his research papers only. And if you found it interesting, then I can assure you that you are in for some more interesting things. If you found it not very interesting, then you can blame it on the speaker, and I can guarantee you that he's a much better speaker than me, having received the Faculty Career Development and Distinguished Teaching Awards. You are in for some good times. I welcome Dr. Lahiri for his part of the presentation.
Mr. Jena, Mr. Sindhwani, Chief Guest, Mr. Rajeshwar Rao, thank you so much for completely honored with this invitation. Thank you to everybody to have come out here. When Mr. Sindhwani asked me to, speak over here, I actually had to think a bit about what to say because, I don't think I know more than you about how markets work and how exchange rates move around on a daily basis. So clearly, there's just nothing that I can actually say which is going to be even remotely interesting to you on that margin. So I instead decided that maybe I'm going to, reach into what I think my comparative advantage is, which is I've had the luxury of not having to react to daily events, and instead, I have the luxury of going away and starting to, taking time to look at what the data suggests over time as opposed to what it said yesterday. And sometimes, not always, but sometimes when you do that, you tend to see patterns which, might get lost on a day-to-day basis because you're reacting by the seat of your pants all the time. And sometimes they surprise in terms of what they start revealing on. So I thought maybe I'll pull out a little bit of that, give you a bit of a more, once removed overview of the way sometimes in academia, even at, in research departments in central banks, whether it's the Bank of England or it's the Reserve Bank or whether it's the Federal Reserve Board of Governors, a lot of the research departments actually people do exactly this. They kind of start, looking at the data with a slightly longer horizon as opposed to a daily horizon. So I thought I'll kind of bring that picture, to a few issues regarding exchange rate determination. And maybe you know it, maybe you don't, but in any event, I think I can learn at the end of it by just talking to you about what you think about some of these features that sometimes seem a bit puzzling to some of us. So with that, somewhat lengthy, mea culpa, let me start. So I'm going to talk about interdependence of monetary policy and exchange rates. But along the way, I mean, let me just start by saying clearly exchange rates are a key macroeconomic variable. So policymakers, businesses, people who are on trading desks and academics are all paying attention to, exchange rates on a daily basis, on a monthly basis, on a quarterly basis, and sometimes on a much more long-run basis, trying to understand why or which direction this might be going over the next not just day or two, but maybe over the next 6 months to a year. Now, this attention is understandable because the exchange rate affects a number of macroeconomic variables which are of interest to a lot of us. So it clearly affects the current account. It will have some effect on the current account. It affects central banks' foreign exchange reserves. It directly sometimes affects banks and firm balance sheets, because if there is any mismatch in terms of denomination of assets and liabilities, there's going to be balance sheet effects. And those have first order implications for credit, and consequently they often have first order implications for what's going on the output side of the economy in terms of credit conditions. And through that, it affects other variables more indirectly. There's going to be sort of spillover effects of these developments onto output, onto employment. And hence, it has lots of far-reaching effects, and consequently, we pay a lot of attention to exchange rate dynamics, trying to both track why it's moving the way it is and trying to anticipate where it might go, because it might have some first-order implications for both policy and day-to-day exchange rate management. So if just from a structural perspective, there are 3 questions that surround exchange rates at a very sort of first-order level. So the first question that I guess all of us grapple with is, what factors determine exchange rates? When I see exchange rates moving around, what are the proximate things that may be moving them around? Now, clearly, depending on what maturity you're thinking of, those factors may well be different. Whether if you're thinking of an overnight market, or you're thinking of a weekly market, or you're thinking of taking positions over a quarter, the variables that you're going to be focusing on are going to be different. But nevertheless, whatever your horizon, you have to worry. At least you must have some structure of the world in your mind about what factors might affect exchange rates. The second related question is, how does monetary policy affect exchange rates? That's clearly a sort of a big issue, because often we are indeed looking at central banks trying to figure out what its attitude is towards exchange rates. Do they have a target for the exchange rate? And if they do, what are they going to do about it? What sorts of central bank intervention policies might we anticipate in order to keep the exchange rate around some target? Or maybe they don't have a target. But nevertheless, how does monetary policy affect exchange rates? And whether they will use monetary policy to affect exchange rates, both are questions that are of fundamental interest. And then there is the third question, which sort of is related to the second one, which is, what should a central bank do about its exchange rate policy? Which is more a normative question. We all have views about this. Business groups have their views about it, academics have their views about it, central banks themselves have, policymakers have their views about it. Should you allow the exchange rate to move freely? Should you be intervening? Should there be some sort of a target range within which you should let it move and intervene if it threatens to penetrate the bounds? But those are all questions about what should the central bank be doing about the exchange rate. So what I thought I'm going to do today is to talk about the first 2 things, rather than the third normative question. And maybe we'll leave that to, during the Q&A, if people want to talk about that, we can discuss, more about this third question about what may the optimal policy look like, in your opinion. But I'm going to focus on the first 2. And in order to stay away completely from your area of expertise, I'm going to be talking about monthly and quarterly frequency data. I will not be talking about very, very high frequency stuff, on which actually I want to learn from you. And maybe there's nothing much to learn from me either on the monthly, quarterly stuff, but at least I think I know a little bit more about that than I do about the daily stuff. So I'm going to focus on the monthly and quarterly frequency in terms of how exchange rates behave. Okay, so It turns out when, when you look at exchange rate behavior over this kind of medium term, if you will, monthly, quarterly, annual, there are exchange rate puzzles all over the place. In other words, it seems very hard to understand the way exchange rates move over this medium and slightly long run horizon. So a pure profit logic in terms of trading profit logics seems to be unable to explain standard medium run exchange rate movements that we typically seem to see in the data. And hence, this whole area is replete with all kinds of puzzles. So what I'm going to do today is going to flag to you a few of these puzzles that we are trying to understand. Some of them we believe that there may be some candidate stories that might explain them. Others seem as Delphic as anything, so we don't have much of a story for it. But nevertheless, there is a puzzle. So this includes the effects of monetary policy on exchange rates. As I'll show you, I'll spend a fair bit of time on that. And we'll see that that also potentially presents a puzzle. But that one, I believe that at least we have a little bit of a sense about why that may not be as puzzling as one thinks it at first sight. But there are some other puzzles that seem a whole lot harder than this, the effect of monetary policy. Okay. So now just to set the stage about the way, in a structural sense, how people think about exchange rate determination in the sort of the medium to the long run, there are two basic approaches to exchange rate determination when people think structurally, whether it's academics or policymakers. It turns out there are, you have to either think in terms of what is the logic of goods trade. Where do exchange rates matter when we start dealing with other people who are on the other side, who has I have something to sell, somebody else has something to buy. So exchange rate currencies by themselves are not terribly useful in the medium to the long run. What they are useful for is for us to transact. So there are two kinds of broad transactions, transactions in goods and transactions in assets. So both of those, there is a logic about those two kinds of transactions, and they have implications for exchange rates. And so essentially goods trade, all these trading logic basically go through some arbitrage relationships that there should not be money left on the table at the end of the day. And so goods trade has its own logic, and that logic I'm going to call purchasing power parity logic. The logic that what determines the trade of goods across countries. And oftentimes we like to think that purchasing power parity may be a good starting point to think about that, and I'll describe what we mean by purchasing power parity. It's a specific sense in which we're going to use it. And then asset trade, there is a corresponding arbitrage relationship which we often focus on, trying to tease out what that predicts about exchange rate behavior in the medium run. And that's through interest parity conditions. What do we know? What can interest parity conditions tell us about exchange rate predictions? And then we can map that to what the actual data looks like to see if these two things are kind of matching up. So let me start with this logic of goods trade and where the profession is in terms of how much we can rely on this logic of goods trade. So this is purchasing power parity. That is this arbitrage relationship. And purchasing power parity, to a first approximation, what it's saying is that when you express the cost of living in the same currency across countries, there should be rough parity. And that's, in other words, another way of saying that is that the purchasing power of every currency in terms of what goods and services it can buy should be roughly equated once expressed, once I convert everything into the same metric, in other words, the same currency. And so just in terms of, I just have put up one, equation up there, which is saying that price levels should be equalized once expressed in terms of the same currency. Now, that seems a bit extreme, but there's another version of it which essentially says that the cost of living should be changing at the same rate across countries, which is a loser condition, which is saying that I don't expect the cost of living to be the same. Anybody who's traveled anywhere will know that, poorer countries are a whole lot cheaper in terms of the cost of living is a lot lower than richer countries. But there's an extension of this purchasing power parity idea is that the cost of living should at least be moving at similar rates across countries. The levels need not be the same, but the rates of change should be the same. So one currency should not be systematically losing purchasing power over time unless it is facing some serious macroeconomic imbalance somewhere. In normal times, what you should expect to see is that the relative purchasing power of currencies are preserved over time. So that's sort of the idea of purchasing power parity. So people have looked at this, that, it has a very clear prediction. I can kind of start looking at what the data says about relative movements in purchasing power or relative movements in cost of living against exchange rate values, and does it kind of line up with the data? It turns out that it holds a whole lot better for developing countries. It's not a bad description of the long-run behavior of exchange rates for developing countries, but it's a terrible fit. When you start talking of developed country exchange rates, this does really poorly. So just to give you a sense of this, I can plot a lot of countries, but since since we are here, I thought I'd plot the rupee against the US dollar. And now in terms of this picture, what this is, the blue line is the inflation differential between India and the US. So clearly Indian inflation, and this is going back to 2000. I'm plotting the data. It's actually to 2015. I just stopped it. I haven't updated this picture. But I find it kind of instructive. So, if you look at the inflation differential since 2007-8 between the US and India, it's averaged about 6% on average. That's the inflation differential. So over a 10-year period, cumulated up, you should expect to see about, about a 60% depreciation of the rupee. 2007, the rupee was around 38, 39. That's where it was. If you take a 60% depreciation, it's going to be pretty much where it is right now. And that's the sense in which it doesn't do too poorly, if you actually use this kind of idea, because what's the inflation differential picking up? It's picking up the rate at which prices are growing, which is the purchasing power of the rupee versus the purchasing power of the dollar. At what rates are these guys declining? That's getting picked up by the inflation differential. If there is any differential change in the purchasing power parity says that the exchange rate should be picking it up so that the relative purchasing power of each currency is preserved. And therefore, if one country's inflation rate is greater than another, you should expect its exchange rate to be depreciating over time. And so what do we see over here? This picture for India, actually the rupee, it's not a bad description. Is it going to be a good one quarter to quarter? The answer is no. But if you actually take a long enough perspective on it, it's not a bad way to think about where the rupee might go. Even now, with Indian inflation having come down, at least for the past couple of quarters, nevertheless, the inflation differential is still about 3%. So what you would expect to see is that it may not happen month to month, that this will, the rupee will depreciate at a constant rate of 3%, but there is this pressure that is always there for this depreciating pressure, which shows up at off periods. It's like a pressure cooker's, cap that goes off every now and then, and you see these discrete, depreciations that happen, which kind of, bring the relative currencies in alignment, so to speak, in terms of this PPP. And you kind of see that. There's this sudden, upward blip in this blue line, which is this pressure cooker suddenly releasing some steam, and the exchange rate depreciates. If I take that same picture, I'll plot the same picture, but now I'm plotting the US dollar against the euro. The red line is the inflation differential. You can see that's the remarkably flat-looking line. And then you see this, exchange rate, which is the dashed green line. And you can see it's moving around an order of magnitude more than anything that the inflation differential between the US and the Eurozone can ever predict. And this is, again, over a 12-year period or a 13-year period. And it's the same. The inflation differential barely exists. It's almost close to zero. And yet, the dollar-euro exchange rate moves around a lot. So clearly, PPP doesn't seem like a good description when you start talking about developed country exchange rates. But when you start talking about developing country exchange rates, it actually doesn't do too poorly. It does reasonably well. And so this is, we often call this the excess volatility puzzle, that the exchange rates in developed countries tends to fluctuate way more than anything that goods trade can explain. Because purchasing power parity is the logic of goods trade. So you might think that goods trade is something that is a very slow-moving object. We don't change our positions in trade very quickly. And therefore, if, there is a lot of asset market activity that is going on, in between two currencies, in other words, those currencies have very deep markets and assets, it may well be that that just swamps anything you're going to see from, exchange rate movements coming from the pressures of the goods market. And so that might be one explanation as to why developed country exchange rates do not seem to, obey the basic, predictions of goods market trade coming through this idea of purchasing power parity. So that then, you can start changing your focus to, okay, what do the interest parity conditions tell us? Those are, there are two corresponding interest parity conditions that economists often like to look at as good predictors of where exchange rates might go. So one is covered interest parity, where you've hedged yourself against any exchange rate risk. You've covered yourself against that risk. And the other one is uncovered interest parity. So if this I used to do all the time when I worked at the New York Fed, of talking to traders over there. And pretty much to a person, they would swear that covered interest parity is just holding all the time. At least at that point it was. There have been some, movements on that more recently. But covered interest parity, to do a first approximation, holds, except for, the regulatory spreads that often show up. So there may be some money, but that's not really, it's just accounted for money, so to speak. So abstracting from that regulatory cost, covered interest parity typically seems to hold. Uncovered interest parity, on the other hand, fails across the board. In particular, once again, for developed economies. You start looking at the G7 currencies, uncovered interest parity is just an abject failure, and so that has led to a huge literature where people try to understand this. Markets understand it, traders understand it. It goes by various names. So one name that is used for this is, it's called the forward premium anomaly. In other words, you would expect that if, traders were not to make systematic money, that countries whose interest rates are higher, on average, those currencies should be depreciating if, people are not just going to make one-sided money. The fact that uncovered interest parity is failing is another way of saying that on average, when you compare currencies with higher interest rates also tend to appreciate, not depreciate, over the next month or 2-month horizon. That seems like you're making money both ways. You make money on the higher interest rate, and then you make money on the way back when you reconvert the funds. So the question is, why doesn't arbitrage take care of this? And so this is why it's a huge puzzle. People understand this, and so the carry trade profits are another version of this. So a lot of people, both in academia and in policy circles, focus on this a lot because it seems like a very nice predictive equation that you can have. You can just take this and try and predict out what might exchange rates do. But unfortunately, this doesn't seem to be a good description because what you want is a condition that actually obeys some profit logic. But seemingly there is excess profits left over, so then it's not a very good instrument to use. Another way of saying this is that the forward rate is actually a pretty poor predictor of the spot rate once you start thinking about developed country currencies. And so that too is a failure of the efficient markets hypothesis when you start thinking in terms of what's going on with exchange rates. So this is a huge puzzle. It exists. We don't know how to deal with it. People have written lots of, I think in my 23-year post-PhD career, I think I probably have seen about 100 PhD theses written on this. And there are close to 1,000 papers that get written on this all the time. So everybody has their own solution, but then at the 1,001st paper gets written as well. Clearly, people are dissatisfied with the stock of the 1,000 that exists before. So it's safe to say that the puzzle exists. We still don't have a clear story as to why it exists. All sorts of risk-based stories is what people use in terms of why certain trading strategies may not work, etc., which is all about understanding risk attitude. But nevertheless, that's a puzzle, so that's why it's going to be a recurring theme. I'm going to keep flagging puzzles that we don't understand, and which is where some conversation is useful, trying to understand why these things might exist. But the other important part that I want you to take away from this is that again, it actually holds a little better for developing countries. It fails across the board for developed countries. So once again, just as a sidelight, in economics, I mean, having spent most of my, almost all my professional career in the West, people spend a lot of time trying to understand why developing countries don't work very well. Okay, so there's been always this focus on trying to, so that focus seems to be that, you know, there's something weird about developing countries. The developed guys are the benchmark, that those are the, you know, they're working efficiently, and it's these developing countries that are somehow messed up. Some of these puzzles are actually saying, no, it's the developing guys who are actually the rational, profit-seeking guys. It's these developed countries that are somewhat weird. They're not working the same way. And so you can extend this to all kinds of development theories as well, as to maybe developing countries are way more transactional, and they kind of look for the last buck, and therefore certain kinds of public goods don't get built because everybody's thinking about what the bottom line is, whereas somehow in developed countries, there is more investment in cooperative outcomes. But those are not necessarily always consistent with individual optimization. So maybe we should be spending more time trying to understand the puzzle are the developed guys, not the developing countries. But anyway, so having flagged those couple of puzzles, let me come to this question of monetary policy and exchange rates, which is the basic topic that I thought I was going to speak on. So this is an extremely old question. I mean, in fact, anybody who's taken any course in economics, I think the first course as this baseline question, what happens when you raise the interest rate? What happens to exchange rates? I mean, it doesn't get any more basic than that, what is the effect on the exchange rate? And there's a conventional wisdom that if the monetary authority is going to raise the interest rate, in other words, there's a monetary tightening, the currency should appreciate. That's the conventional wisdom about it. Somewhat interestingly, there is not a whole lot of systematic empirical work on this, where people have looked at, does this conventional wisdom actually show up in the data or not? What little exists is almost exclusively for developed economies. And indeed, for them, this conventional wisdom does show up in the data, that when interest rates go up in the G7 countries, their currencies tend to appreciate. That's the baseline. So I'm going to just tell you a little bit about some work that I have done on this to try and find some new evidence. In other words, extend this, at least the empirical, study to a whole lot of countries, not just developed countries, but also focus on developing countries. There's no reason that these developing countries, they are raising interest rates as well. They are worried about exchange rates as well. So this is about a joint work where we looked at a broader set of 72 countries over a period of the post-Bretton Woods period from 1974 to 2010, when exchange rates were flexible. And we looked at a set of 25 developed and 47 developing countries that had flexible exchange rates, in order to examine this relationship in a more broad sense, that not just developed countries, but looking at a more general picture. What can we learn about the effect of monetary policy on exchange rates? What is the effect? So what we did was we proxied monetary policy by interest rates. So we looked at T-bill rates and discount rates, depending on which was a closer approximation to what the central bank of that country is doing. And everything I'm going to show you pictures and or tables. And so all of those, whenever I talk about exchange rates, what I mean is local currency units per US dollar. That's the exchange rate we are using. So whatever my exchange rate is, if it goes up, that, it basically means the local currency is weakening. If it comes down, the local currency is appreciating. So that's going to be the notational convention. So we examined the relationship using very simple kinds of correlations and much more fancy modern techniques, using econometric methods and so on. But again, a basic principle of all of this is if you're not getting something in the basic relationship, some simple methods, and it only shows up in more complicated methods, it's time to revisit what you're looking at, because the first approximation should be that it should show up in the simple stuff. And then maybe you look for robustness by looking at more complicated methods. So I'll start with this very simple way of demonstrating what I want to show. Of course, to do this, I mean, just as a side note, we have to have, because we are talking about exchange rate behavior in response to interest rate movements, so we need to look at central banks that actually allow their exchange rates to move. So if often a lot of central banks don't let their exchange rates move, in which case this question becomes moot as to what is the effect. You might then want to examine what's happening to their foreign reserves and so on. That's a different question you may want to ask for countries that do not allow their exchange rate to fluctuate. But we decided to just look at countries that actually allow their exchange rates to move and to see what is the effect of when they change their monetary stance, what is the effect on their currency. So therefore, to identify these flexible exchange rate regimes, we looked at, there are these two economists at Harvard, Carmen Reinhart and Ken Rogoff, who've come up with a classification going back to 1945 of countries' exchange rate regimes based on looking at precisely what was actually happening with their exchange rate behavior. So they classify countries into various groups. So we picked up the countries that they classified as flexible during those periods. So essentially that choice of sample left us with about 80 country episode pairs, because some country could have fixed exchange rates for some sub-periods, then they might switch their policy and get into flexible rates, and then they switch back. So you could have multiple flexible exchange rate periods for any one country, so that's feasible. So basically we have 25 developed, 55 developing episodes, country episode pairs. So I don't want to think about just Brazil as being a country, I want to think about a Brazil flexible exchange rate episode. That's a unique identification for me. But of course, you need to have this experiment for a long enough period of time so that I can actually, identify the effects. So, so we say that a minimum length that a flexible exchange rate episode has to last is 2 years. And then I'm going to allow that to be in my sample. So I believe I can identify something sort of useful from there. So here is the simple correlation between interest rate changes and the exchange rate. So I've broken the countries into developed and developing. Remember, when the interest rate goes up, if the exchange rate the exchange rate tends to come down, that's really an appreciation of the exchange rate. So when the RBI is raising interest rates, if the number of rupees per dollar comes down, that's the rupee appreciating. So when you see a negative correlation, that's essentially the conventional wisdom, that when you raise interest rates, the currency should appreciate. So that's what you're expecting to see. You're expecting to see a negative correlation between interest rates and the exchange rate if this conventional wisdom is showing up in the data, that a higher interest rate is going to appreciate the exchange rate, the currency. Well, when you look at this developed country column, that's exactly what you see, whether you look at the absolute levels, whether you look at, first differences of the exchange rate, those correlations are all negative. And that's what I was describing earlier, that this conventional wisdom actually comes from people looking at what's going on in developed economies, that when interest rates go up, their currencies do tend to appreciate. But then you look at what's going on under the developing country column, that's a whole different ballgame. Those countries' currencies, when the central bank is raising interest rates, those currencies are depreciating, not appreciating. So it's the exact opposite. So of course, this kind of first approximation can lead to all kinds of questions of what is causing what. So is it the case that the exchange rate movement is causing the central bank to behave by, when the currency is depreciating, that's when they're raising interest rates? Or is it the interest rate movement that is affecting the exchange rate? So those are all, perfectly logical questions. This is where you have to now get into more somewhat fancy econometrics to kind of identify this properly without, all of this getting confounded by reverse causality in some sense. So that's what we did. There's a method called, don't worry too much about what the method is. It's one particular statistical method. It's called vector autoregressions, VARs. And, it allows us to identify the effect of an exogenous shock to the interest rate. It's an identification mechanism. So what this method tries to do is to control for this endogeneity, that, or this reverse causality. That's what it tries to control for. So bottom line from this table, once again, what it shows is that, when there is an exogenous sudden increase, an unanticipated increase in the interest rate, what happens to the exchange rate? In 84% of industrial countries, the exchange rate appreciates. In 75% of developing countries, the exchange rate depreciates, the exact opposite effect. And then you sort of cut ahead 1 month later, basically this is not dying out. This is like, this effect stays. The, industrial country currencies remain appreciated, 88% of them a month later, 84% of them, the currencies remain appreciated, 84% of the cases. In developing countries, on the other hand, this is again, they depreciate on impact and they stay depreciated for, at least up to 3 months. And then once again, whether you look at first differences or not, it doesn't matter. So clearly something very different is going on between them. So as a first response to this, you can say, okay, this is a puzzle. Developing countries seem to be behaving very differently from developed countries in terms of their response to monetary policy. So the question is, this seems like a puzzle, so is there any sense in which we can try to start understanding where is this coming from? Why is there this difference between them? So of course there can be a lot of candidate stories. So one of them could well be that central banks in different countries respond very differently to domestic conditions. Some may not be responding quite as aggressively, while others may actually be accommodating what's going on in domestic conditions much more aggressively. And so it may well be differences in central bank behavior. It also could be the different abilities of central banks to be able to commit whether or not I will respond to exchange rates or not. So some central banks might say that I will allow the exchange rate to float freely, but markets may well not believe that. They say maybe these guys have some target in mind, and that's what the central bank does. If they start seeing the exchange rate moving too much, then they start intervening, even though they might say we let the market, the exchange rate find its market value, but truth is that they actually start intervening in response to fluctuations that are beyond their tolerable levels. And the tolerable level may well be kind of central bank specific or country specific. Lastly, it could well be, or not lastly, but another one could be that there are very different risk premium shocks that are hitting developed countries versus developing countries. The way developing country assets are perceived by markets may be very different from developed country assets, and therefore the movement of that country risk premium may well be extremely different, and that is something that is maybe picking up why you see these different behavior. So once again, this methodology, which is going to start looking like a magic bullet to you very soon, because I'm going to keep using this VAR approach, can control for a lot of these. That does that basic asymmetry between developed and developing countries survive controlling for these kinds of factors? And the answer is yes. For example, you can start thinking about interest rate or central bank behavior that is responding to lots of domestic conditions. And so we have 8 different specifications where we control for, allow the central bank, interest rate policy or monetary policy to respond to various kinds of domestic conditions and to risk premium shocks. So for example, the specification 7 is allowing the exchange rate to respond to the risk premium, to what's going on to output, what's going on with inflation, what's going on to, of course, the interest rate differential between the home country and the US. So it's allowing the standard things that people focus on as central bank variables that central banks look at, which is, output, what's happening to employment, what's happening to growth, what's happening to inflation, and also exogenous risk premium shocks that could be hitting the country on its own. Whatever you do, this basic result does not go away. There is a clear separation between developed and developing countries, that developed countries, in response to an unanticipated tightening of monetary policy, the exchange rate appreciates. In developing countries, an unanticipated tightening of monetary policy induces the currency to depreciate. Okay, so that is across the board. It's the same kind of picture. That basic asymmetry just doesn't go away. So this is another way of just representing it all in terms of one picture. Is these 2 pictures. The average response in developed economies is on the left. So when the interest rate in a developed economy, in a typical developed economy, goes up, the exchange rate appreciates on impact and stays appreciated for a while. That's that blue line. It's saying that on impact it comes below 0, it's appreciated. and then it stays appreciated for a while, and in developing countries, the exact opposite. That, the exchange rate depreciates on impact and stays depreciated for up to 3 months. And so that's the average response. So now this is, sometimes known as the exchange rate response puzzle, that we don't quite understand why monetary policy seems to have such diametrically opposing effects in one group of country versus another. And they're being ordered purely by developed and developing, emerging markets versus developed. That's the only difference, and you can almost predict what will happen. So one way of thinking of it is trying to, this is where, as I said, we have the benefit of, in at least the kind of job I used to do, and I hope to have a similar kind of window here as well, that, we have the benefit of actually having a little bit of time to look at data as it comes in, as evidence as it comes in, and so to collect evidence over time, because then you might be able to tease out what's going on as opposed to responding to data on a very, very, quick basis, because you just don't have enough sometimes. And so we kind of started looking at it from the, I guess most of you must have been in markets when the Asian crisis hit. So in the late 90s, when the Asian crisis hit, there was like a vituperative debate that broke out about what to do. And there were two sort of major players on the two sides. On the one side, you had the IMF, who were being led at that time. Their strategy, at least, was being articulated and devised by Stan Fisher, who just actually very recently resigned from his position at the Fed in the Board of Governors. And on the other side, there were people like Nobel Prize winner Joe Stiglitz, you had people like Jeffrey Sachs, you had people like Danny Roderick, who are all very influential commentators about what's going on. And the debate was exactly this, that the IMF had this view that these currencies in these East Asian economies are just hemorrhaging. These economies, the Indonesian rupiah is tanking, the Thai baht is tanking. So the first order of business is to stabilize these currencies. And their recommended approach was to raise interest rates. Just raise interest rates, you need to raise the demand for domestic currency denominated assets. And that's when you're going to start stabilizing, because people are just wanting to flood out. Malaysia, of course, responded by saying, no, you couldn't flood out. It was capital controls. They just put in place a bank holiday and just shut down all flows overnight. But the rest, the response, if you were not willing to shut down markets, was to raise interest rates, to make this profit taking and exiting, making it as expensive as possible. So making it very expensive to short those currencies. That's what they were basically doing at that point, in order to increase the demand for domestic currency denominated assets. That was the IMF's view, and that's what Stanley Fisher was arguing. On the other side, so that's what we kind of call the liquidity demand effect, if you will. It's increasing the demand for liquidity in the domestic country. On the flip side, you had people like Stiglitz and Jeffrey Sachs, who were arguing that this is insane. These countries are dying. Everything is in meltdown. This is a terminal patient, and we need to give this patient some artificial resuscitation at this point. And you are saying, let's pull the plug and just give him some even more shocks by raising interest rates. These are places that output is in a free fall. So what we have to do is actually cut rates in order to boost, employment, ease up credit conditions, etc., in order to, get the economy moving again. So that is sort of what we call the concern about output effects of higher interest rates. As you start raising interest rates, credit conditions become tougher, become tighter, and therefore markets begin to shut down, or credit flows begin to come down, and consequently, employment starts coming down, investment starts falling. So that's a negative shock to output. So that's a cost. There's another cost that people worry about. That a big part of the problem in these Asian economies at the time was the fact that their fiscal burden was very high. They were running these fiscal deficits. There were a lot of implicit guarantees that were there that the banks had, and so people thought that these were prospective deficits that people anticipated, these markets had anticipated. Now, in this world where with all these banks failing and prospective bailouts on the horizon. There was lots of incipient demands for government spending that were going to show up because of bank failures. If you actually raise interest rates some more, now you're increasing the debt servicing burden, and therefore the fiscal effect is just going to be debilitating, and that's going to kill markets even more. So so this fiscal effect and the output effect effectively were the critics of this IMF policy were focusing on that. These are effects that tend to weaken the currency. If people think that the economy is going to tank, they're going to try and run out of the country, and therefore those are effects that kind of force the currency to try and depreciate. Whereas this domestic, liquidity demand effect is the positive effect, that you raise the returns on domestic currency assets, you might increase the demand for domestic money, and therefore the exchange rate might start strengthening. And so what actually happens in response to higher interest rates at all points must be some trade-off between these offsetting effects. The liquidity demand effect tends to strengthen currencies, whereas this output effect and the fiscal effect tends to depreciate or weaken currencies. So of course, what's happening on the net when I ask all these questions about those tables I was showing you earlier, that what happens when interest rate goes up, what happens to the exchange rate, that net effect must reflect these offsetting forces. And so one way of thinking of this is that maybe, just maybe, the positive liquidity demand effect maybe is stronger in developed countries, whereas these output and fiscal effect, these negative effects, are much stronger in developing economies. And maybe that is why we see these differential results. So we actually looked at that, and that's the sort of, I'm just giving you a quick takeaway line on this. So remember when I was showing you those tables and I said, we had these 80 country episode pairs. So some were appreciating in response to higher interest rates, others were depreciating. So if I were to try and predict who was appreciating, who was depreciating, I could just try and first up use their status of whether they were a developed economy or they're a developing economy. I could use that to try and predict. That actually is the first column. And it's basically saying that if you are a developing economy, the chances that your currency is going to appreciate in response to a higher interest rate is very low. That's that negative coefficient, minus 0.04, 0.4. That's basically saying the probability that your currency is going to appreciate in response to a higher interest rate is actually very, very low. It's reducing. The fact that you're a developing economy is reducing the chances that your currency is going to appreciate in response to a higher interest rate. But if these stories that I told you about these various effects that are running around in any economy, this liquidity demand effect, the output effect, the fiscal effect, those are not developing economy phenomenon. These are just phenomenon that operates in every country. So this story would say that once I start controlling for the strength of these effects, the liquidity effect, the output effect, and the fiscal effect, then the predictive power of just this identifier, whether you're developed or developing, should disappear, because it should all come down to whether or not these effects are dominating. This developing is just a stand-in for all these other effects, if my theory is correct. And it turns out that's exactly what happens. That's that last column where, I still have that identifier, for countries, whether they're developed or whether they're developing, but it just loses any explanatory power. So there are no stars. So the way you want to think of these stars is that, when you don't have stars associated with those numbers, it effectively is indistinguishable from zero. Okay? That's what it means to not have stars next to your name. So therefore, next to that number. So effectively, in that last column, developed or whether you're developed, whether you're developing, has no further, predictive power for whether your currency is appreciating or depreciating in response to higher interest rates. What ends up soaking up all the explanatory power is this last variable down at the bottom, which is the level of M1 to GDP. So M1 is nothing but, your currency plus deposits in the system. That's what it is. And so that picks up almost all the explanatory power. So if you have, more M1 to GDP, if a country's M1 to GDP ratio is high on average, they are more likely to see an appreciation of their currency in response to a higher interest rate than a country that has a low M1 to GDP. Now, what is M1 to GDP? Clearly, cash is one component of it, but the rest picks up things like financial development and financial deepening. How far are banks, being used in this economy? What is the extent of financial inclusion in an economy? How many people are using banks in order to carry out transactions? Because that is a key component of the demand for domestic. That positive effect is the demand for, as you raise interest rates, how much of a positive effect is there going to be on the demand for domestic currency denominated assets? But a key component of that is the part that is part of the formal system. It's beyond cash. It's these other assets like deposits, etc., on which the whole edifice of the financial structure is built. But if that base itself is low, the strength of that positive liquidity effect is actually very small. And that is the main difference between developed and developing economies. This is not to say that the strength of the output effect and the strength of this fiscal effect are symmetric across developed and developing countries. The output effect is also stronger the negative effect is also stronger in developing countries. The fiscal effect is also stronger. Their fiscal positions are much weaker. But nevertheless, that is not the first order reason why you see this asymmetry in the effect of monetary policy on exchange rates. It is the level of this financial deepening and financial development. That is the fundamental reason why you see this difference in responses. So that's kind of the main takeaway that at least we have, that why does financial deepening matter? Now, why does financial inclusion matter? Because conventional ways in which policymakers think about monetary policy and its effect on exchange rates depends crucially on it. Because if that margin is weak, it's all going to be counterfactual. It's going to be counterintuitive. It's going to go in the wrong direction. So now I want to go to so that's, as I said, there was kind of a puzzle, but it's no longer a puzzle if you've solved it. So I think we believe that in a somewhat, not very bashfully, I guess I'm claiming that I think we're reasonably confident that, a lot of the explanation for that asymmetry in monetary policy effects across countries resides in that financial, development variable. So now I want to get to another one on which I don't have much, deeper insight, but I'll flag the issue to you. So this is now a sort of a very loud, feature in a lot of countries, in terms of how their central banks are operating. What is the key central bank operating procedure? A lot of central banks have embraced inflation targeting. So inflation targeting has gradually started with the Bank of New Zealand back in the late 80s, early 90s, but since then, that group of countries that have explicitly adopted inflation targeting has actually grown a lot. India too has recently joined that group. And so this notion of inflation targeting as the way of conducting monetary policy, as the key goal of monetary policy, has underlying it a couple of key principles. So one principle, of course, is that it has to be a univariate target of policy. Do not get into this multiple targets, so to speak, because that ends up confusing, sends confusing signals to the market because nobody is quite clear. So if you want to, a big component of, I guess another way of saying what I just said is that if you want to control inflation, one key component of it is to anchor inflationary expectations. If inflationary expectations are not anchored, it's very difficult. You have one instrument, the central bank has one instrument, but what people are, when you decide to write contracts for 6 months ahead, 1 year ahead, you need to have expectations about where this inflation rate is going to settle. And that is the inflation expectation. So if that is wild all over the place, people don't have an anchor, it's going to be very difficult to control inflation independent of what the central bank is doing. And so inflation targeting is an acceptance of the fact that our best way to anchor inflation expectations is to actually focus on one variable, say that is my target. There is complete clarity on what the target is. In other words, whether you're using CPI, whether you're using core, or whether you're using headline, whatever your measure of the inflation rate is, and what the level of that target is. So that also has to be clear. Communication is fundamental. in order to anchor expectations, because you can't be sending confusing signals. And so, inflation targeting has that aspect that it's only one target of policy, and the best way to, the flip side of that is that, once you clearly communicate, this policy is supposed to essentially directly ignore any effects of employment and output. That's at least by construction, that is what it's supposed to be doing, that it should not be directly responding to employment and output. It should be focusing on stabilizing prices. And again, the idea is that somehow stable inflation is the best way to stabilize output. And another way of saying that is that is, the central bank's main product, or one of its main products, is money. So managing the value of your main product should be your core competency, and maybe that's the one you should focus on. The rest happened through much more indirect methods and indirect ways of, that's the monetary transmission that is imperfect at best. And so, instead of getting distracted by imperfect mappings, focus on the one that you directly control. And that is your most, favored contribution, if you will, to stabilizing output, is by at least taking care of one key component that might lead to output fluctuations, which is inflation volatility. So stabilize inflation, you'll help in stabilizing output. So now the way it works, of course, is through the monetary transmission. Whereas as the central bank is changing the interest rate, it is affecting aggregate demand conditions. And through affecting aggregate demand, it will affect output, and it will affect, therefore, inflation. But the pure inflation targeting regimes have, as a key underpinning of it, is that you should not be responding to the exchange rate. The exchange rate should be a purely flexible exchange rate. Indeed, they actually expect the exchange rate to fluctuate in order to, that's the source through which the relative prices for my goods versus some other country's goods is going to stabilize precisely through this exchange rate fluctuation. That is the method through which the external accounts are going to actually stabilize, if you allow that relative price to move. And there's an old saying in economics that you can't manage, unless you want to turn into Russia or unless you want to turn into the ex-Soviet Union, you cannot manage both prices and quantities at the same time. You can either target prices or you can target quantities. You have to let the other one kind of, endogenously move. It's when you try to target both that you have either shortages or excess stuff that nobody wants. So that's basically what ends up happening. This way of thinking of this is that, if you do not allow the exchange rate to fluctuate freely, your relative price, the real exchange rate of your, goods versus foreign country goods is going to be, essentially not moving too much. And consequently, there's going to be a huge amount of output volatility. Quantities are going to move too much. So if you actually want to stabilize output, you want to allow the exchange rate to move, and that's going to sort of prevent quantities from moving too much, because it's prices that are going to be moving. Cross-country prices are going to stabilize. Okay, so that's the idea. Let the exchange rate float, just target inflation. That's the pure inflation targeter. So this issue actually came up because since I was living in Canada till, a month and a half ago, the Canadian exchange rate for the past year and a half, or past 2 years, has been on this free nosedive that has happened. It was close to parity with the US dollar, about around 2015. And by 2017, this thing had depreciated about 35, almost 40% in a matter of, just about a couple of years. So that's what got me and a colleague of mine to start looking at this. So we started with Canada, and I think Canada is instructive in terms of what's going on. So here is the Canadian example. So Canada has had a flexible exchange rate going back to 1974, once they got off the Bretton Woods. They adopted inflation targeting only in 1991. Till that time, or in 1992. So for that 17-year period, they had flexible exchange rates, but no inflation targeting. So if you look at the correlation between the Canadian dollar and oil prices, what you find is that the correlation was positive. When oil prices were going up, the Canadian dollar would tend to depreciate. Remember, if this exchange rate is the Canadian dollars per US dollar, so when oil prices were going up, the number of Canadian dollars per US dollar was also rising. So that was the Canadian dollar was tending to depreciate when oil prices were rising. On the flip side, when oil prices were falling, they would tend to appreciate. That was the pattern. Flip ahead to the post-inflation targeting, during the inflation targeting regime, that happened starting 1992, January 1st. And you see an exact opposite. What has happened is that the Canadian dollar now appreciates when oil prices go up, and it depreciates when oil prices fall. It almost seems that the Canadian dollar has become a commodity currency. After, or oil currency more specifically, but the same thing applies actually. You start looking at commodity prices and so on, very highly correlated. Commodity prices, oil prices tend to move together. So the question is, what exactly is going on, or is this just a Canadian phenomenon? Something about Canada might be special, and that's why we are seeing this. So actually, just over the last couple of weeks, I've been looking at this on a more general basis, trying to just look beyond Canada, because as I said, the set of inflation targeting countries has now grown to about 27 for whom we have decent amounts of data that we can use to examine all of this. So we look at 27 countries from, again, over this entire period from 1974, January 1st, till, 31st July 2017. Monthly data is what I'm looking at. Different countries have adopted inflation targeting at different dates. Because one quick, very quick take on this particular Canadian fact could be, well, maybe it was something very special about the time that Canada adopted the inflation targeting regime. And so what you're calling inflation targeting is really some time-specific thing that is going on, that it was a particular period when this happened. But this doesn't apply to, once you start looking at 27 countries who have adopted inflation targeting at various dates. India just adopted in 2014. And various countries have adopted along the way at different dates. So whatever I'm going to find is not going to be contaminated by some time-specific thing. And so here is what I find. Just again, one quick number, and the stars are again to say that, this is, it's not zero. It's clearly distinguishable from zero because I have stars. So what is this saying? It's basically saying that the exchange rate, so just focus on the first column. So it's saying that the exchange rate by itself, the oil prices, when they go up, they tend to push the exchange rate in the same direction. In other words, that's that Canadian feature that I started off with. The general effect of higher oil prices seems to be to depreciate the currency. But the second row is the oil price star inflation target. So, but in those countries, during periods when they are inflation targeting, it goes the other way. In response to higher oil prices, their currency tends to appreciate. So now, in countries which are inflation targeters, there are clearly two opposing effects going on. The direct effect is tending to depreciate the currency, which is the effect of the oil price, but the inflation targeting effect is causing the currency to appreciate, and indeed that effect dominates. So their currencies on average tend to appreciate in inflation targeting countries when oil prices go up. Looks weird, but then you say, okay, maybe what's going on is just these oil exporters are driving all of this. That there are a set of oil exporters in there, oil prices are denominated in terms of US dollars, and maybe that's all that's going on. So then, if that is true, once I control for the share of oil exports, because that's what is going to matter there, what fraction of your exports are coming from oil, once I control for that, then this effect should go away. This inflation targeting effect should disappear anyway. Doesn't happen. That's that second column. Once I control for oil, that effect is still there. That negative entry, very significant and very negative. It's saying that that effect of higher oil prices tending to appreciate currencies in inflation targeting countries remains independent of whether you're an oil exporter or an oil importer. That doesn't matter. That effect is always there. It almost seems like becoming an inflation targeter is converting their currencies into commodity currencies, independent of whether they are commodity exporters or importers, which is the weird thing. Why is it doing it? So I don't have the answer to this. As I said, this is like a 2-week-old thing that I'm showing you. It's kind of fresh. So I'm still thinking about what may be going on here. Partly, I think, and this is where maybe you can tell me that I have no idea what I'm talking about, which may be well be true, actually. But entertain me or humor me for one slide. So I guess the way I think of this, one possibility is that markets, when they're trying to price an asset, you often need an anchor as to how to price an asset. You need some anchor on either supply or demand of this asset before you can price it. So it could be, as I said, a quantitative target, or it could be a price target, but without a target, it becomes very difficult. Again, I see some gray hairs in this audience. So some of you might remember this episode when the euro was coming into being. So the euro came into being on January 1st of, I forget, 98 or 99, one of the two. So in the lead up to the euro accession, there was a lot of debate about how all these different currencies, how should we fix the exchange rate of the franc to the euro, the Deutschmark to the euro. There were lots of different ideas. One idea was that let them trade on a shadow market for 6 months before, and we'll just take the price that exists at close of business on 31st December of 98, and that will become the opening price on January 1st when the euro comes into being. That, most market practitioners and policymakers said, is exactly an example of something that sounds reasonable and yet is a terrible idea. And the reason it's a terrible idea is because you have no anchor to price. Our pricing is often based on expectations about where the price is going to go. If I don't have an end target of, or at least a sense of where that price is going to go, you essentially have an indeterminacy. It could have any number of solutions that you might think may be viable. So you're opening up the market to huge amounts of volatility because nobody has a clear expectation or an anchor about where this market's going to go. And so that's exactly an example of a poor idea about how to price this. And so that was not done. That proposal was not adopted. But inflation targeting has that aspect. Pure inflation targeting has that aspect. Because all of a sudden the monetary authority is saying that, hey, look, I'm just targeting inflation. I don't have a quantitative target for how much money I'm circulating in the economy. I don't target output. Output may be, well, a quantitative target as well. And I'm not even telling you the price about what that exchange rate value should be. I'm a pure inflation targeter. So you neither have a price target nor do you have a quantity target. That is the world where the market's beginning, people are beginning to miss a nominal anchor. How do you price a variable that you have no sense of where it's going to go based on any either quantitative target or a price target? When that happens, markets find their own ways of anchoring it. That's called a focal point. I don't know what to do, but so we focus on something. One particular focal point, which everybody can, it's a completely public signal, could well be the oil price. That we all focus on the oil price, that's the way I price it. That when the oil price goes up, the currency, I'm going to sort of say this currency is appreciating. When the oil price comes down, it'll depreciate. One possibility about breaking, when you have an indeterminacy, you cannot price an asset, markets find some way of breaking it. And so how do you break that? There are many candidates. It may not have been oil price. It could have been something else. But it seems from the data that the oil price clearly is a significant variable to predict where the exchange rate is going to go. And so maybe that's what's going on. So of course it raises some practical issues when you see factors like that. We are seemingly beginning a cycle of slight rising oil prices. It's beginning. Oil prices have been firming up. What these results tend to suggest is that therefore, in a whole set of inflation targeting countries, you should expect to see their currencies having appreciating pressures. Those currencies are going to begin to appreciate against the US dollar. Now, how does it impact us? Clearly, if we are going to if the rupee stays stable against the US dollar, that will of course mean that there will be depreciating pressures on the rupee vis-a-vis all these other currencies. That in turn leads to questions beyond the trading aspects about where the rupee might go against all other non-US dollar currencies, as long as the rupee stays stable against the dollar, is of course what do our trade flows depend on? Do they depend on the rupee dollar exchange rate, or do they depend a lot on bilateral exchange rates of these other currencies with us? And so some other studies we are doing right now seem to suggest those other bilateral exchange rates are of first order importance in trying to explain trade flows. And so clearly this will have consequences. This is not an effectless kind of result that because overall, our overall effective nominal exchange rate will indeed depreciate. That's what's going to happen. The second takeaway from what I just said is that if I'm even remotely correct, even an implicit exchange rate target that is not articulated clearly, but if markets kind of understand that the central bank has some target zone, that they will not allow the exchange rate to move too far off this basic target zone, that might itself be enough to stabilize the currency. It may not actually need any active intervention. This is one of these cases where you almost may not need to do much. It's a signaling effect, maybe enough to anchor expectations and to keep currency volatility at bay, where it's almost like it's cheap talk. You don't need to do much, but just a simple signal sometimes, whether implicit or explicit, might be enough to stabilize this market. So that's sort of the set of things that I wanted to say. So I'll just conclude by saying that exchange rate behavior in the medium and the long run is often, we find, extremely puzzling. There are puzzles all over the place, and so I flagged a few of those. Some seem resolvable, others seem incredibly both interesting and somewhat unclear. And so any help that we can give each other, I guess, from short horizon versus long horizon, I think might inform and help both sides of this to try and get a better sense of how exchange rates might move. But again, the one last thing I think I should say one more time is that anchoring of expectations of exchange rates, I think, is very important. It's not quite articulated like that when people talk about, in at least developed countries with inflation targeting, nobody talks about it. But I think it's very important because those exchange rates can come unhinged very quickly because markets do not have an anchor. And so they come up with their own, seem to come up with their own anchors. All right, I'll just stop here.
Thank you very much, Dr. Lahiri, for presenting this very complex topic in a very lucid manner, I should say. You presented the puzzle, tried to help us see some logic in that, and also how the different level of development of the country, developed, underdeveloped, or developing, and with the different behaviors of the central bank, how all these factors can play a role in the overall exchange rate market behavior. I'm sure people would be having some questions, especially because most of the people are here worried more about the short-term movements than the medium and the longer-term movements, and how we can find a balance between these two things. And we have got some time maybe for few questions. If you have anything, Dr. Lahiri is here to address that. And even after this session, maybe he'll be around with us for some time during that dinner time also, and we can continue having discussion with him if there are specific queries or certain things, clarifications you want. And yes, please.
Dr. Lahiri, something more contextual right now. Given the soft patch in growth that we are actually witnessing right now, does it really make sense to, get into an expansionary fiscal policy as a response to the, the current growth swoon? We of course need to see the data and see whether this is more cyclical or more structural. But I'm really, the question is around an inflation targeting framework, which by its very construct ensures that, any proclivity of the fisc to kind of expand is offset by a tighter monetary policy. So, in terms of the response to growth, is that a viable option? Is monetary policy itself a viable option given the penchant of the RBI to hit its medium-term inflation target of 4% really on a durable basis? Given the, the propensity of, prices to move, at least food prices to move a fair bit. And if both these are not viable options, could the central bank actually look at the exchange rate, to kind of loosen monetary conditions and, give basically a kind of a growth impulse from a weaker currency? And how would that, if that's a viable policy option, how would that really intersect, with the propensity of the central bank to kind of hit its inflation target, given the exchange rate channels, the impact of the exchange rate channel on hitting the inflation target?
So you've asked a very wide range of issues here. So, I guess, so let me take them one step at a time and go in reverse order. And let me just go in reverse order because the exchange rate one is somewhat easier to answer. Exchange rates are helpful in as much as they preserve your relative, the competitive advantage that you're going to get, that it's going to be preserved rather than just a one-shot, 1 month, 2 month advantage, and then, because you're constantly competing with other countries in terms of, so what prices those other countries are setting in terms of their goods is also a variable that they are re-optimizing over. So if your core competency is in goods where you have a fair bit of market power, and so the only thing that matters is that, the relative demand for my goods versus your goods in terms of, and that's the effect that the exchange rate's going to have, then maybe it does have some bang for the buck. But in a world where, if you're competing in a fairly competitive fringe, that exchange rate mechanism is not going to get you any long-lasting, competitive advantage, because that margin is just going to go away very quickly because you are in a competitive fringe. So it becomes a judgment just on the export side. What is the segment in which one is operating? Do we think our main exports are in sectors where we have a fair bit of market power, or are our main exports in sectors where we are taking things as a very competitive environment? So whether or not you're going to get a competitive advantage is going to be a bit of a function of that. My sense at least is, and this is, over time, even with stable exchange rates, competitive advantages go away simply through price pressures, which is what the IT sector has clearly figured out now. That's exactly what happens. The exchange rate is a much more low-hanging fruit, so those things dissipate much faster in some sense, in terms of how, in a competitive sector, that's what's going to happen. On the flip side, there is a cost, which is the part that you asked, that as that exchange rate begins to, if you allow it to move, there is an import component which is going to transmit into the inflation at home. Given that a big part of our costs are in terms of, a big component is fuel, which is all dollar denominated. So we are looking at a significant effect on the import bill in terms of rupees. Now that inflation either is going to come out of, the fisc sort of beginning to respond poorly to it, because either you have to cut, either you raise costs. If you're not willing to do that, it has to be the subsidies have to fall or the taxes have to rise. One of those two things has to happen in order to clear this market. So if the government is not willing to pass on all these increases to the consumer, it's going to come out of a higher fiscal deficit. There's just no way around that. So both directly and indirectly, it's going to contribute to higher inflation. I mean, so that is a constant threat. And to get a sort of a long-lasting effect, if you will, or a bigger window, a small 5%, 2%, 3% depreciation of the rupee will not do it. You need a rupee depreciation which is far bigger. But that's exactly where those costs are going to be incredibly high. And so, at least to my way of looking at this, seems like the wrong way to think of things. That it seems like an easy approach, but it's probably A, not long-lasting, B, not even feasible if you're going to also maintain other macroeconomic targets along the way. In terms of monetary stance and growth, this transmission process from monetary policy, so we always comment about it from, you know, from let me just say from the academic side, and even when you talk to central banks, globally, there is always this sense that somehow markets have a much more optimistic sense of the power of monetary policy to affect output and growth than the true transmission of monetary policy. And which is why this gradual adoption of inflation targeting, at least my sense, has come precisely from there. That a gradual acceptance that the ability of a monetary authority to impact growth through this interest rate or monetary policy channel is A, very indirect, and B, that mapping is extremely volatile. And so to bank on that mechanism to correct problems that actually originate elsewhere, countries get stuck, except you're talking of Zimbabwe or hyperinflationary worlds and so on, things like that, leaving those examples aside, countries get stuck in low growth, poor growth environments because of frictions or distortions that exist in sectors that are completely non-monetary in origin. And so to correct those non-monetary problems or distortions with a monetary instrument which is not sort of directly impacting those, it's some sort of an aggregate instrument, is creating distortions in other sectors where none exist, in effect. So you're introducing imbalances along the way when you do that. And hence, I think, and that's where I'm coming back to a basic question. All focus on growth, on what kinds of policy incentives or policy initiatives we should be thinking about in order to think of growth, have to have as a first step a clear sense of where the friction is, or what the holdup is. Because that's what's going to tell us what's the best policy. Because the question that you ask, and is the right one, is that what is the best policy? And the best policy has to lie in the domain of where can restrictions be removed, where can existing policies be reformed, which are not about just infusing aggregate demand into an economy or to ease monetary conditions. These have a lot to do with just direct restrictions on activities that exist, either due to factor markets being distorted somehow, either it's land or labor, or it's other kinds of infrastructure bottlenecks that prevent those sectors from growing. If some of those, like the infrastructure side, rely on a fiscal, require a fiscal, boost, that seems reasonable to focus on growth. But it has to be very clear-headed. It can't just be a generalized infusion of aggregate demand and saying that this is going to lead to, consumer demand growing across the board. That usually doesn't happen. It has to be much more clear-headed than that about where exactly is the bottleneck. I think people have a sense of where the bottlenecks are, but sometimes the easier solutions are to focus on something that you can do very quickly as opposed to the harder ones, which are trying to remove these much more embedded bottlenecks in the system, whether it's resolving land acquisition problems or whether it's resolving labor laws, etc. Those are harder problems, but those may well be the more fundamental ones. I'll just...
I think we'll take one more question we have got here. And after that, I'll request in interest of time, and certain people have got some other engagements also, we can continue. Dr. Lahiri is going to be here. We can continue having discussion with him if there are any specific topics to be taken it up. So, one more question.
Thanks, Ashwini. The last question. Thanks, Dr. Lahiri. That was a very erudite presentation. So, in fact, some of the slides I've taken photographs of to read later on. You're right, we are a bunch of short-term traders who rarely can see beyond our nose. So we have the luxury of giving you a very short-term reflection. Couple of points really. One is on the very interesting observation you make about in developing countries, episodes of monetary policy tightening seem to be go the other way around, where you actually have currency weakening as opposed to maybe one way of looking at it is looking at real interest rates. If I was to look at the Indian context itself, in the 2010, 11, 12 period when we actually had monetary tightening, real rates were actually coming down because inflation was actually going faster than interest rates. And the reverse works right now. Though we have monetary, cuts happening and accommodation happening, real rates actually have gone up, and therefore maybe the currency strengthens, which may be one explanation. The second part on the last part you mentioned about monetary policy and effects on anchoring expectations. My own personal view as a trader is anchoring expectations in developing countries like India can have a pretty negative effect of increasing complacency. In this year alone, we've seen a significant amount of unhedged exposures build up. In a sense, because there's a sense of an RBI put or a call somewhere, anchoring both the extremities. If anything, I think letting loose uncertainty in the market might be a better way of diffusing that, tendency. Just these two observations.
Let me I totally agree with the real rates. In fact, I didn't show you the gory structure so it works through the real rates. But the real rates at the end of the day, I think episodically it does explain. So the structure we have actually works through the real rates, but that can't explain all of it. So we have to have, but it does explain some. So episodically it does explain some of it. You're absolutely right on the anchoring expectations. There's always this issue of does the central bank become like the ultimate insurer for markets, and therefore markets start taking unhedged positions. I guess the answer, as all things in life, is the boring one, which is the optimal point is somewhere in the middle. You kind of don't want a completely unhinged expectation that nobody has a clue of how to form expectations. And the other one is, I'm always reminded of a long time ago when I was, when I was working on my thesis. I worked on high and hyperinflation economies. That was my thesis topic. And so this was in the early 90s, and Argentina was just coming out of a hyperinflationary episode at the time. And so just to give a sense of what the costs of unhedged expectations are, so I remember seeing a book with a picture in downtown Buenos Aires. There was a shop, and the picture had the shop had a sign in Spanish, and it said, translated in English, it said, "Closed for the lack of prices." So it's basically this shop owner doesn't know what price to charge. If inflation was just going to be at 200% every month, he would know what price to charge. The problem is precisely because it's so volatile that he doesn't know what to charge. Now, that is one extreme, and the other extreme is where it's flat as a pancake, and people say it's all stable, I don't have to worry, which is the other end of it. So I guess, as all things, as I said, the boring answer is somewhere in the middle. You don't want either extreme as being, I think, the right one.
Now we are coming to the conclusion of the session. I will request Shri Ashutosh Rena to give memento to Rajeshwar Rao on behalf of FEDAI and all of you. I will request Jena sir to give memento to Dr. Amartya Lahiri on behalf of FEDAI. Now, Mr. Ashutosh Arana will give vote of thanks and then the back side is open for you.
Good evening, everybody. I've been entrusted the responsibility of proposing the vote of thanks and conclude this FEDAI annual day. To start, I'll thank Mr. Amartya Lahiri for a very informative and I'd say beautifully presented exchange rate behavior, how the exchange rates are moving and how they affect the day-to-day. I thank Mr. Rajeshwar Rao for again highlighting the importance of the code of conduct and which we are going to adopt very soon. I thank everybody for making it to this event and making this event a grand success. To conclude, I thank Mr. Ashwini Sindwani and his entire team for making this event a grand event. Thank you, everybody.